Welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guy TV. So what has happened since I saw you last is we've actually had a hurricane hit the area that I live in, Charlotte, North Carolina. So I wasn't able to actually tape a show on Friday, Options Guy TV. Everybody is fine within my world, but the whole area as a whole is struggling a little bit with all the water. And it's more than a little bit. But with that said, we're going to soldier on here and start by looking at the trade that we proposed on Wednesday, which is an XOM. And since that trade has happened, there's been some geopolitical concerns over in the Middle East, and it's kind of driven up just oil prices and energy companies in general because of the news and the potential for that whole area to escalate as far as a full-blown war is concerned. Literally, that's what the news has been. So in ExxonMobil, we had a real nice support level right around the 117 area. But more importantly, there was a much bigger support right around the 120 area. The stock actually hasn't been above 120 going all the way back to April. It's came up and bumped up against that a few times. But right now, the market has moved above the 117 and it closed above that. So we are taping right now. This is a recording of the show. And the markets are closed. It is Monday, September 30th. So it gave me a chance to look at the ExxonMobil trade and into a little bit more detail. And I'm going to propose an adjustment to the trade. And it's not too exciting of an adjustment, but I think it's worth mentioning. And sometimes I've done this in my own account. And we're just happen to be at a spot where you might consider doing this adjustment. So I thought I would start by introducing that to you. And then we're going to come back and we're going to look at a trade in the VIX heading into the October month, just like we did heading into the September month. At the end of August, we looked at a trade that was looking for the VIX, or the implied volatility index, to go higher, and we put it on at the very end of the month, and on the very first trading day of the month in September, the VIX actually kind of skyrocketed, and the trade did fairly well. This is all about the seasonality of the VIX. Geopolitical concerns are really, a thing at this point in time. We still October. We still have the election. We're still a little bit nervous about the Fed rate cuts and what's going on in the jobs area. Inflation seems to be tamed a little bit. And that's kind of what happened with just the Fed in general. A lot of people were nervous when they went 50 basis points, even though it was the marketplace was saying there's a 50-50 chance that they were going to go 50 basis points. I felt like the market actually got blindsided by it. The market closed down at the end of the session after the Fed announced the 50 basis point cut, and then just decided that, oh, by the way, if they went 50 basis points, they must feel pretty good about inflation, and then the market just took off. And that was in the futures market and set a new high actually a few days later in the S&P 500 index. So once again, just a lot of volatility, a lot of weirdness, I would say, in the marketplace, because you see the nervousness that the 50 basis point cut created, and then all of a sudden they didn't. And then you look at the VIX, and the VIX is trading down around 16 right now, just showing some complacency in the marketplace. So where are we going to go to next? So we're going to take a low priced speculation trade in the VIX, which there are all speculation trades in the VIX in my mind. And lastly, we're going to look at a bullish but nervous trade, also based off of the VIX, based off of the 50 basis point cut. We're going to try to get long a home builder. So like I said, 25 minutes or so. It's going to be kind of a little bit of a longer show, but let's get rocking and rolling. So I'm going to start by let's run to the Tradier Pro software, and I'm going to zoom in specifically from April out, okay, in XOM. So I'm going to grab this corner, and you see how big of a run up it had going into April of 2024. And I mean, it was solid. It almost looked like NVIDIA there from this range, from 100 all the way up to 120, a 20% move in the underlying stock. But then once it broke down, it really never came back. Okay, so here's this area that we're talking about. So I'm not 100% nervous on this, but this was a level of support right around 117. Market came up, finished down below. Now it's back again, and it's touched and it's bumped through. And every single time that it bumps through a level of support or resistance, this, now it's resistance to the upside. Every time it touches it, you feel a little bit more nervous that it's going to break out. But we sold the 120 calls, and look at the support on this area right up here, going all the way back until where it actually broke through the 120 level, all the way back at the end of April. And we saw the breakout all the way down. So you feel pretty comfortable in this range. And I mean, it's almost a rinse and repeat strategy. The market comes up to 119, you sell the 122s until you see that kind of a breakout. And then if you do get the breakout, you can actually flip the script and get long. That's really what we're seeing here. But you have the 50-day moving average, the 20-day moving average. This is a death cross. It's crossing over the 50-day moving average. I think it matters a little bit more when we're talking this technical analysis piece. Matters a little bit more when you're talking about the 200-day moving average and one of the slower moving, faster moving averages crossing over the slower one. So in this instance, the chart still kind of looks bearish, but I wanted to say that we put the trade on, and I grabbed the screenshot from that Wednesday. The market was at about 115 and a half, 115.50. We're now trading at 117.22. It was up strong today, 1.19%. And we got that trade on for 61 cents. And that's fairly important to me. Now, we got some time left in the trade. We're going out to October 25th. And you could just say to yourself, well, I think it's broken out. I'm a little nervous that 120 is going to be the next stop. And so I just want to close out the trade. I'm down about 20 cents on the trade. I'm just going to get out. Or I look at it as I paid 60 cents, or I received 60 cents for selling this trade. Sometimes I don't mind just adding a long call. And I usually want to make that almost the net credit that I brought in. Okay. So hang with me here. Like I said, this isn't the most amazing type of trade. It's okay. And there's going to be times where you will consider it, especially like now where it's really driven by news and what's happening in the marketplace, not necessarily by fundamentals. It's really just the geopolitical issues that are going on. 1025 is the expiration. So let's go all the way back to this expiration right here. XOM, this is the trade that we have on. And you'll note that the 123, and this is part of the reason why I'm bringing this up, is trading for a little bit more than the credit that we received when we put the trade on. So all I'm proposing is that you just buy the 123 strike extra call in this instance, which will get you long this position. In other words, you will be positive delta to start. And if this momentum continues, you can sell the 123 and or you can close out the entire trade. But here's what it looks like if we add one onto here, it's going to be a little bit different because it's as of today, but it's fairly close, right? So you're right now, if you did the add-on, you would have a ratio spread and it would be a net credit of 7 cents. So it's really going to cost us about 7 cents overall to put the trade on. We paid 60, and this is trading for 70, 67, 70. Yeah, we could get it done somewhere near 71, 72. That would be a really good fill. That'd be at the midpoint. So you're talking we net credit of 61 cents that we brought on. Let's call it a dime. Let's say that it would cost us a dime to put this trade on. And then if we look at the what if calculator, now that we have one and we are selling two, so let's go and pull this up a little bit. So I added one to the position here. So we've sold the one call that we want the market to stay behind, and then we bought an extra call. So if you look at that trade right now, if the market does start running to the upside, you're down on the trade at this moment. But if we get to 121, we're profitable. We're making 50 bucks on the trade. If we get to 122, we're profitable. Now, if you hold it all the way to the expiration date at one, and it stops right at 123, well, then you got double whammy. You paid for the extra call, and that call didn't make it. So this is the valley of death in here. But if I have a momentum trade that's going on, and I'm not necessarily saying that XOM is there, and I want to just flip the script and go from being bearish, neutral to bearish, to all of a sudden a little bit more bullish on the trade, just by using the net credit from the short call spread to pay for an extra call, that means that if the market goes down, I lose a dime. That's the maximum I can lose on the trade if the market goes down. We brought in a credit of 60 cents. We're going to buy that extra call for 70 cents. But then if the market goes up and we get that momentum over, we got to the 25th. So we got probably a week to 10 days that I would consider just being in this trade, and hope that the market actually does break through the 120 level and finishes right around 120, 122. Obviously, if it blew away, you're long one extra call. So if the stock ran to 130, you're looking really good. I wouldn't expect that. I would be getting out right around the 120 to 123 level over the next 10 to 14 days. That's the way I would look at the trade. All right, so I thought I would share that with you because I noticed that the 123 call was trading for about the net credit that we brought in. Bottom line is the chart doesn't look horrible, but we did finish above that 117. 120 is really strong. It's all about, are you willing to stick around and see if it would bump up and come back down off the 120 level again, like it's done. It looks like 1, 2, 3, almost 4, almost 5 times. So the more that it keeps bumping up against it, though, the more you get a little bit nervous that it might break out to the upside. All right, so that was too much time on XOM. Let's move on to the next trade. So inside, I got them all loaded up inside the what if calculator. Now I want to look at my long butterfly in the VIX. So this trade, I am going to put it on in my account, manage the risk just by the cost of the trade. And let me send this to the trade ticket. Here's our trade. I'm going to click this right here inside the Tradier Pro what if calculator and send it to the trade ticket. And we see that, well, the midpoint is 75 cents right now. So that would be our maximum risk on this trade. And if you look at the chains, now I do want to emphasize, I did put out the article inside my Twitter, it's handle @BrianOverby, that explains the weirdness of the VIX and how the VIX option contracts are priced off of the future. So feel free to go through my feed. I put it out last week before all the stuff happened. And it gives a good perspective on why the VIX futures matter so much more than the spot or the actual VIX index when you're trading options in the VIX. So we're going to do the October 16th date, which is the monthly expiration, by far the most liquid. I always want to try to trade in the monthly expiration. It's got 16 days to live. So this is a very short trade. The other trade that we did in at the end of August had a little bit longer expiration date just because of where the third Wednesday fell in the month. And in here we have 17 is the VIX is trading at 1673. But if you look at it to know where the futures is where the futures market is trading, you have to look at, okay, the 18 strike call option in this expiration is at 163. The 19 strike put option is at 145. So the call option is at 126 here. The put option is at 145. So it's somewhere in between 18 and 19 right now. In other words, if it was right at the money, you would expect the call option and the put option to trade almost at parity, very close on a shorter term option contract. But right now you see that the 18 is more expensive here, and then the 19 is more expensive there. So that is literally the combination. That's a way to get synthetically long stock by selling the put and buying the call. And so this is the way that you got to calculate it. Or else you can go to cboe.com and go to and get delayed quotes on the futures. You can find them there. Right now, the quotes are wiped out, and I think it's just because the market's closed. But for some reason, I cannot get a futures quote on cboe.com. So 75 cents. That means $75 for every 1x2x1 butterfly that we're going to put on. But we modified this butterfly. We sold a credit spread to help pay for our long spread or our debit spread, and we stopped short. We didn't make it a complete butterfly. So we're going to go all the way back to the what if calculator and look at what this does to our profit and loss graph. It makes it fun. If the market goes down, we can lose 75 cents. It's that simple. That's where we're at. It's just like a standard butterfly. If it's below your strike, which it's trading right there right now where the futures market is at, if it's below your strike, you will lose what you paid for it. 75 cents at the midpoint. That would be our net debit to the account, and that's what we pay. We go up to 1 to 23, and we finish somewhere around 23 at the expiration date, which is feasible. It's possible that could happen. Well, the maximum that this thing can trade for is the width between the strike, the first strike, the 18 strike, and the 23 strike, the one that we sold. And you're looking at 5 points. So it'd be 5 minus that 75 or 425. So if you look over here in this corner, you'll see that profit and loss graph. It's right around there if I get it right on that range. Okay. But then the downside of a standard butterfly is that if you go further, usually you can lose on the upside. And in the VIX, that's always a possibility. But in here, we're happy. If the VIX actually goes beyond our high strike, because the width between 23 and 26 is only 3 points. If it takes off and it skyrockets, then we're still profitable on this trade. And once again, I'm going to highlight over here, the width between the long strike was 5 points and the short strike is 3 points. So that means this would be worth $200. That's what this 1x2x1 butterfly would be worth from 26 on up. But we paid 75 cents for it. So $2 minus 75, and you'll see right over here it's saying 128 over in this corner. But that's where your profit and loss is at, right about there. 128. If we do it for 75 cents, it would be 125. So I like this trade. Now, here's what we're giving up also. If we do this trade and we go back and we look at the trading page here, you see that if we did a standard butterfly, and this is 5 points wide, so this would be 128. So what this costs us to get the benefit of having unlimited upside in the VIX, just because of just the way the VIX is and the way the options are priced, it's different than any other index, right? There's nothing that is as weird as the VIX if you're trading them. But it's interesting to trade them. I find I enjoy it, and especially in September and October. Okay, 26, 28. 28, if we just look at the ask and we don't focus on the midpoint, the markets are closed, so the markets are a little bit wider than normal. But you're talking about 38 cents versus 44. So 6 cents difference. you're paying 6 cents to get the benefit of, if the VIX takes off above 26, you make $200. If you look on it on the asking side, it's 7 cents. So it's somewhere in that range. So I ask you, is it worth an extra 7 cents to have your what if calculator look like this from the 26 strike on up, from your protection strike on up? And I say, yeah, without a doubt. I don't think I would ever do a standard butterfly in this. I would look at a skip strike, something where I'm doing it for a net credit. But this is, to me, truly a modified butterfly. And yeah, we're paying 75 cents. Now be prepared that if the market doesn't move or it starts drifting back towards the spot, which is 1673, yeah, you can just get out of the trade. Don't be looking for a home run. Don't be trying to make $5. If you put this on for 75 cents and you can double and you sell it for 150, nothing wrong with that. It's all about the size and the management of the position. I would probably look to try to sell that. I would, as soon as I executed this trade, I'd put an order in to sell it at 150 good, or 250 good till cancel. That's what I would do. And then I would watch the marketplace and see where it's at, because the VIX is so sensitive to what's going on in general. And with the geopolitical concerns, I really think that this is an interesting trade going into October. All right, I'm getting a little bit long-winded, but I do want to do a bullish but nervous trade, and this gives us something to watch. So I'm going to be very quick about this. I have not just bought a long call on Options Guide TV in quite some time. I like DHI. The interest rates came, the Fed came in and went 50 basis points. And interesting enough, a lot of the home builders have, it's one of those buy the rumor, sell the news. And let's actually show that. And you can look at a few other of the home builders. But you see this going right into, like, 190 was right here. This was right at the day that the Fed announced the interest rates. And ever since then, and the market kind of got surprised with the 50 basis point cut. Now, that doesn't show up in the mortgages right away. You know, it takes a while for it to work its way into the system. But ideally, mortgage 30-year mortgages, the interest rate's going to come down. That's ultimately what's going to happen. Not to mention, going into 2025, they're talking about a potential of 4 more rate cuts. So with that said, DHI and a lot of the home builders have held their own through this huge increase in interest rates, but it's still trading at 12 times earnings. It still has very strong fundamentals. And there still is, not enough houses out there. The price of a home has stubbornly stayed higher. As a matter of fact, that's probably as far as inflation is concerned, the biggest concern is rent and just housing costs. It's really, for the Fed to hit its target down at about the 2% level. So bringing this down, looking at where the market is at, let's take this opportunity. We're in October. It's going to be volatile. I'm not worried about October as much. I don't anticipate that I'm going to be selling DHI by the end of October. Market goes up, that's great. I just think it's going to be a lot of chop in October in the home builders, and then we're going to get long. So you could wait a week. I would be okay with that. You got earnings at the end of the month. I think D.R. Horton is announcing on the 28th, actually. So if you want to wait until earnings and get in after that, that's okay with me. I just would rather be in it prior to the earnings, and I don't want to buy it too close to earnings, mainly because I don't want to pay the pumped up juice that the earnings report might bring on. So very simple. And I'm still, once again, talking way too much. So let's get to the trade. Here it is, D.R. Horton. We're going long call. We're going way out in time. Let's pull this up. Let's send this to the trade ticket. And so it's a real option contract, but this is opposed to buying 100 shares. We are bullish long-term on DHI. Actually going out to the May expiration, I kind of think it's not long enough, but I don't mind that because I will roll these positions. I don't mind paying a little bit less upfront. We are in October. You are a little bit nervous. So instead of paying all the premium going out a year in time, we're going to go out into that May expiration, which is, let's see how many days away. Give me the exact date. January, February, March, April, May. 233 days away. So we have quite some time. We're going into 2025. So we're almost, a little bit shy, a third or 3/4 of a year or so in this instance. Okay. We're going to buy it. $37.75. If you look at that and you say, okay, D.R. Horton, let's put it up here, DHI, is trading at 190, and we're going to buy this 165. And that delta is changed on me. Oh, I didn't click on me. Okay, we're going to buy the 165. The delta, come on, there it is, 79. Very close to 80. You could look at the 160, but man, that was a lot more just to get to the 81 delta. This is close. My goal is to fire up something right around an 80 delta. That means I'm going to get 80% of the stock price movement. If I bought 100 shares of DHI and the stock went up one, I would make $100. If I buy this option contract and the stock goes up one, in theory, in the theoretical world, based off of the delta, you should make $80. So a lot of stock price representation, but it is still an option contract. There's still about, let's call it $8 worth of time premium in this option contract. So we still got to deal with that, and we'll try to manage that time premium. But bottom line is, if I'm buying this as a surrogate for owning the stock, this is the ideal situation of bullish but nervous. I'm going to put up 20% of the stock price. If I were to buy 200 shares, I'd buy 2 call options. If I was thinking 300, I'd buy 3 call options. And I'm going to limit my risk to 20% of what that total cost would be. And that's the most I can lose, but I'm not going to allow myself to lose that. If the stock comes down to the 165 strike, I'm going to get out. And that's usually my line in the sand. Here's one of the biggest things. Obviously, you have a lot of time, 233 days until that expiration date. But if it comes down to that level, well, then it's going to be an at-the-money option contract, right? So if the stock came down to that level, it would be trading for what the at-the-money is trading for right now. There you go. Quick and easy little, you don't need a pricing calculator, don't need a what-if calculator. This assumes as of today, right? So there's no time decay. But it goes from 36 to 21. That's not that bad of a loss. And if it hits 165, I was wrong on my forecast. I'm going to get out. That simple. And that's the way I like to trade deep in the money call options. Bullish but nervous in the home builders. Trades at 12 times. Great fundamentals. Great, just solid numbers. And I want to get long it before the earnings date, but feel free to wait until after if that's the way you wanted to approach it. That's it for this edition of Options Guy TV. My name is Brian Overby. I'm going to be back. I think we're back in the saddle again. I don't anticipate any power outages, but then again, I kind of got blindsided by one today. So today is Monday. We'll be back on Wednesday at 11 a.m. Eastern time. If you'd like to learn more about what I'm doing in the financial situation, please follow me on Twitter. My handle is @BrianOverby. And please check out the Tradier Hub. A lot of great speakers inside the hub. Sign up and put a profile in, and that would allow you to ask questions during the show via inside the Tradier Hub. Thanks for stopping, and we'll see you on Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.